All right, everyone. So, good day. This is the lecture on interest rates and present value. Let me just share my screen. All right. All right. So, today our lesson is on interest rates and present value. So, if you could open your handout for interest rates and present value, this morning we will discuss about basically loans. So it's quite different from our last lesson because we discussed about macroeconomics in our last lesson. But in this lesson, we are going to discuss about loans, no, and present value. So it's not exactly a very difficult concept actually when you discuss about present value and interest rates, but we will see how it affects our or how it contributes to our idea of the economy. No, now I'll just refer as well to our. I'll just share my handout. No, we'll refer to the handout in the classroom. So our objective for this lesson is for you to be able to understand what interest rates are. No? So that's the first thing that we are going to go through, and then recognize why present value is a tool to use when thinking about economic decisions, where the costs and benefits of the decisions happen at different times. So as what I mentioned, present value refers to the value of our currency during different time periods. No? So here we will learn or recognize why present value is a tool to use when thinking about economic decisions, where the costs and benefits of decisions happen at different times. All right. So going back to my main, I'll just stop the screen for now, to my main PowerPoint. Right. So interest rates. Now, interest rates, I would like you to think of a loan that you made recently. I'm not even sure if you students are have ever done a loan, such as an actual um, formal loan in a bank or in a cooperative. No, if any of you have made a loan, how about a loan from an informal loan from someone? Whether you loaned money from your friend or your family, because let's say you needed money to buy a nice outfit or you needed money to buy a new game that's coming out in PS4, so you borrowed money from a friend, no, in order to buy a new game in PS4, um, or you borrowed money from a friend in order to pay for something that you wanted to buy, or you borrowed money in order to pay for your tuition, for example. Your parents might have done that. That's actually quite usual enough for borrowing money to pay for tuition or to pay for electricity, to pay for rent, borrowing money. But in those cases wherein we borrow money from others because there's no interest rate now, interest rates doesn't really apply to those examples. Okay, for example, if you borrowed money or your parents borrowed money to pay for your tuition, where did they borrow the money from? If they borrowed the money from, let's say, a pawn shop, maybe your parents might have pawned their cell phone. If their cell phone is high end, iPhone, a higher end model of the iPhone, or if your parents have pawned their jewelry, whether that's gold, no, and then they use that to pay for the tuition of their children, or if your parents loaned money from a cooperative, no, some cooperatives actually um, give loans to people, or if your parents actually loaned money from a credit card, so a credit card also has an interest rate, or if your parents have a credit card, no. However, if your parents borrowed money from someone else, no, in order to pay for the education of their children, and then there was no interest rate for that, then that's not exactly included. But there are some people who do put interest rates in the money that they lend to other people, but more often wala interest rate. No, there's no interest rate if you borrow money from someone you know. In any case, um, interest rates. Now, a pawn shop would put an interest rate to the item that you would pawn. So, for example, if a person now, let's not just talk about your parents, but maybe if a person in general goes to a pawn shop, and ang pwede man madawat sa pawn shop is gold, no, gold or other precious jewelry, but mostly gold. Dili apil ang pearls usually for some pawn shops. That is kani sa Pagasa pawn shop or sa Cebuana or sa Luwilier or dinhi sa Cebuan, what's the term, Palawan pawn shop, no, dili kay nagakadawat ang pearls, but they do accept gold, no, some gadgets, and then laptops. Now, the pawn shop would give you money, would assess your item. For instance, if you pawned your cell phone, for example, the cell phone would be the value of that cell phone would be maybe 2,000 to 5,000. Gamay ra gid kay siya class, no. But let's say dili kay siya high-end nga phone, no, or iPhone siya pero di kay siya recent nga model. Maybe mahatag siya at 5,000. So the pawn shop would give you 5,000 in, and then a 10% interest rate. So an interest rate is when people, for example, in the case of a pawn shop or even in a co-op, no, for example, in FICO. So FICO also offers loans to their members. When you are a member of a co-op, you are part of the you are partly an owner, quote unquote, of that cooperative. You are an investor in that cooperative, no? But you also get a savings account, and then a loans account, and then a shares account as well. So the co-op would usually give you a passbook, and then the passbook would be where your transactions would be listed, no, whether that's your savings. You would put your savings in the co-op instead of a bank. And then it's the same as well for a bank, no, there's also an interest rate put on loans. So for example, in a co-op as well, in a cooperative, if you become a member of a co-op like FICO or Maspec, so there's a co-op here in, I think, in Mindanao, no, located around Yakapin Street. No, yeah, that is Yakapin Street here in CDO. So if you're part of a co-op, you get a savings account. So the idea of a co-op, or rather some cooperatives teach their members how to manage their finances better. So part of financial management is saving, no? Saving your money and then investing your money, no? Not just putting your money in a safe place so that it will just stay there, but you could also you could also use that money to loan and then to invest in a business, no, or invest in a car, invest in a house. If you are planning on, not, it's not an investment, but loan money from the co-op in order to finance buying a car or a house for adults already who are thinking about buying a house na. It's this. I think it's the same mechanism for Pag-ibig, although Pag-ibig is for housing. Anyway, to put it simply, there are interest rates that are put on loans. In the bank, I think, of course, it's the same in the bank. So if you get an account in a bank, whether that's BPI or BDO, you also get a savings account. But if you become a long term, say, if your account becomes long term, no, and then your salary is put in your bank account, and then if you get a good track record, the bank sometimes would offer for you to get a credit card or for you to get a loan, no, from the bank. So it's important for consumers to also loan money, because essentially when people just save but do not loan, then the bank, no, or the co-op actually has more money, but then nobody is really investing their money anywhere. So it's co-ops would encourage their members to get a loan in order for their stock money. I'm not sure if stock money is the term, but for the money's co-op circulate, because they could also get an interest rate if they could get a profit if their members would loan, no? So that's where interest rates come in, because if you're a co-op, for example, or if you're a pawn shop, interest rates are essentially how co-ops, pawn shops, or banks earn money, because as people borrow money from them, they also get profits from the interest rates. So yes, why is it important for people to loan money? Because when you loan money, that actually also um, increases spending in the economy. So, for instance, if a person loans money from the pawn shop in order to pay for tuition, no? Or to pay for rent, or to pay for food when they don't have anything anymore, so that would, of course, you would get, as what in the example that I gave, if a person pawned their cell phone, and then the value of the pawn was 5,000, so giatagan they gave their cell phone to the pawn shop. Eventually makuha raman na nimo imong cell phone balik when you pawn it, as long as mabayaran nimo balik ang 5,000, and then with interest na siya. So around a 3-month period, or rather you can actually renew your pawn 1 month period na siya usually. So for example, if ma-pawn ang cellphone, um, the loaner, no, should pay off that cell phone in a month's time. But if dili nila mabayaran ang pawn after 1 month, pwede nila ma-renew ang pawn, meaning dili pa nila makuha balik ang ilahang cellphone, pero magbayad sila interest sa pawn shop kay para dili lang sa sila makabayad. But if makabayad na sila sa 5,000 nga nabayaran, di ba? Why did they get 5,000 again? Because the value of the cell phone for the pawn was about 5,000. So they got 5,000 in return, and then but in return they had to pawn their cell phone to the pawn shop. So the pawn shop has the phone, they get 5,000 for that phone, and then they have to pay that 5,000 back in a month's time, with interest na siya to the pawn shop. But if dili nila makuha balik, mabayaran balik in a month's time, they can renew it for another month, but they have to pay the interest. Then eventually, if they're ready to pay off the pawn already, they just have to go to the pawn shop and then pay back the 5,000 and then the interest, I think, and then they can get their cell phone back. That's the idea of of the pawn shop. So um, with that, it's important for people to loan in a way, because they could get emergency money, but also it spurs spending in the economy. How about for co-ops or banks, right? So for co-ops, there are different types of loans. So for instance, there are, let's say for example, in a co-op, right? There are car loans, no, there are business loans. So if a member of the co-op wants to start a business, but they don't have any capital, they could go to the co-op, no, or the bank. It's the same as all for banks, because banks also offer car loans or business loans, but at a higher at a more sophisticated mechanism compared to a co-op. So yes, if a person wants to buy a car, then they could, but they don't exactly have. Usually, cars. Now, when you buy a car, you have to get a loan from either a bank or a co-op. So, usually as well, the requirements of a co-op for a person to be able to get a loan is if they have a track record of getting loans and then paying back loans on time. So with that, it's sometimes, example for FICO, I'm a member of FICO, usually class. For example, for FICO would require their member to continually deposit savings in FICO, but also they should get a loan, such as a loans against deposit, wherein so that they could see that the loaner has a track record of paying their loans on time, and then they can see that you can pay your loans on time within a certain year, no, then they can approve you to get a car loan. So then if you get a car loan, you could get a car. And then it's important for people to loan basically in order to get the things that they want, whether it's a car or a house or a business, no. And then that could be good for the economy. So it's these are the financial institutions, the banks, and um, other financial institutions such as cooperatives or yes, or pawn shops. But yes, so that in that sense, it spurs the economy. So um, the loaners would get something in return, such as money, or they get to loan. So utang ragyapon sa siya, pero at the same time, they can get a commodity such as a car or a house, no? And then within a few years' time, they could pay off that loan, whether it's a 3-year period, 5-year period for a house. Not sure if it's a 5-year or 10-year period to pay off a loan for a house, but that's the idea of interest of loaning. Now, for interest rates, however, this is how businesses, or rather banks, no, it's the same as for a bank, no. If there are some bank account clients who loan from a bank, there are some requirements such as a co-maker. You have to have someone else to sign the documents in case you are not able to pay for the loan. Then there's someone else who would pay for the loan for you. And then there's also a track record as well. And then for example, for a business loan, the applicant of the loan should have certain, they should have a track record as well as a bank, excuse me, a track record in the bank. And then they should also pay off the bank loan on a monthly basis. So that's for interest rates, or rather for loans. Now, for interest rates, however, when people lend or borrow money, such as in the examples that I gave, now whether that's in a bank, in a co-op, or in a pawn shop, even to a degree for cars and the houses, for real estate properties. When you buy a condo, for example, or a house, you should put a down payment first, whether the down payment is about 15,000 to 50,000 or 100,000 down payment, and then you pay off the house eventually, no. But then I believe there is an interest rate for I'm not sure if for cars. I think the interest rate goes to the bank now where you are loaning from. So if you loan a car, then you should have a bank now that approves a car loan. If you are loaning a house, or rather if you are buying a house out of a loan, then I think sometimes the loan also courses through a bank. So, but there are some loans that are coursed through co-ops as well. FICO, for example, also offers car loan, and then they can actually be the financial institution for paying off a car loan. So when people lend or borrow money, we call that price at which they do this the interest rate. So sometimes, for instance, in the case of a pawn shop, they put a 10% interest rate. So if you loan 5,000, you would have to pay for you would have to pay an interest rate of about 5% or 10%. So that's around 250 pesos to 500 pesos interest rate. So it's quite high, not 200 to 200 peso interest rate. And so the pawn shop would receive 200 pesos in addition every month that you renew. So it's a small interest rate, or it's a small profit, but on a span of months. How about for co-ops? There's an interest rate of I think around 8%. So if you loan, let's say 15,000 loans against deposit from the, or 30 to 30,000 loan against deposit from the co-op, then your interest rate could be around 8% or 10%. So your interest rate would be about 300 pesos per loan or per month. So when you pay off 300 pesos per month, that would equate for 1 year. If your loan was for a year, they could get 3,000 pesos more or less, no, from your loan. So that's a lot of money that a co-op could earn from your loan. And then for a bank, it's the same as well. Sometimes I'm not sure how much the interest rate is, but if that's the interest rate, then that's the profit that the bank could get from your loan, no, per month. So again, the interest rate refers to, usually it's the percentage which is usually expressed in annual terms of a balance that is paid by a borrower to a lender that is in addition to the original amount borrowed or lent. And the idea of interest rates, as I mentioned, is quite important in economics um, because it spurs the economy. No, in the level of financial institutions, it helps people get emergency money, as what I had said earlier, or it also helps business grow. Because if businesses would get a loan to start their business, then that would be good for the economy. The businesses would have profit if their business goes well. They could get livelihood as well. Instead of being unemployed, why not start a business and then see how it goes? You could get capital from the bank or the co-op that could lend you money, and then you could employ workers, and then you could get profit. You could sell products now towards others. So that's the importance of financial institutions, basically banks or co-ops, because during in economic activity, you could be assisted in the venture that you're trying to start off. And it's the same as well for investors. Investors actually get an interest rate from the investments that I believe that's already in the level of shares, no? So if an investor buys a share in a business, or even for co-op members, they put their shares in the co-op, they would get a dividend, which is somewhat like a return of their investment. So those are some mechanisms in financial institutions such as banks or co-ops, no, that could spur the economy and assist people in getting, let's say, car loans. So even growing their money, no, and learning about financial management, getting money as well for their needs. So um, there are also other types of loans. I believe there are loans for people who want to go abroad. Even there are some co-ops as well that offer when we say they call it spot cash. So spot cash that you could use to show to that you could use to put in your bank account. The person who gets a spot cash loan would buy or would apply for a spot cash loan so that they could have money to put in their bank account, so that when they want to go abroad, sometimes when they want to get a visa for another country, let's say if they travel to Europe, no, to Austria or Germany, or France, no, or in America, or to Australia, and then they are applying for a visa to these countries, then sometimes the consul, when they are looking through the application of the person who is applying for a visa, they would look at the financial capacity of the person, to be if the person is able to fund such a travel abroad. So spot cash is sometimes a money now that you can borrow from a co-op, for example, in order to put money into your bank account, just to show that you do have money to go abroad, and just for proof not to the consul when you're applying for a visa that you do have financial capacity to pay for your travel to another country. So those are types of loans as well. So if you can see, loaning is important. It's not about not loaning, because eventually it's not very good for, let's say, for adults who already have money, no, to just keep their money in the bank all the time, and then wala ni mo gi-invest imong kwarta. Because it's good to have emergency money. The what some institutions teach, no, financial education teaches people that when you have money, you have to save for at least 3 months, no, 3 months worth of what you need. So in the span of 3 months time, or rather, when you save money, you have to save money, your emergency fund first. So that's good for 3 months of your needs. So let's say, for example, for a working adult that does not live with their family, maybe they would need about 20,000 per month. So your emergency fund should be 60,000, more or less, before you should, or before you ought to, or maybe 10,000, not 10,000 to 3 to per month, um emergency fund. So you should save about 30,000 before you apply for a loan, because that's a basic lang sa financial education. You have to have a base savings first before you go and proceed to, excuse me, to other things in your financial management, before you proceed to buying an investment or getting a new loan. So as mentioned, it's important to loan your money, or rather to get a loan, no, in order to also to get what you want, whether travel abroad, you loan money for that, or you buy a car, or a person buys a house, no, so or a condo, or if a person buys tries to even create a let's say there are also other types of loans wherein a person also constructs a rentable business center, or if a person constructs an apartment building, so they could make it into a lucrative source of income, no. So when they have a business center, they could have renters who would rent for that space, or an apartment where renters would rent for an apartment. So loaning is important as well, because businesses, no, or people who want to start off a business could get capital for their business, as mentioned earlier. So that's interest rate. That's the idea of an interest rate. Shortly, I will show videos about um, I will show videos about interest rates and present value, and then we'll discuss these. Next, we also have the idea of present value. So, as mentioned, present value refers to the value of a commodity, no, during a certain time. All right, class. So I'm sorry about that, because the video was cut. So I'm actually re-recording or rather making another video in order to continue the recording. So I left off with explaining about present value. So present value, as what I was mentioning in my slide, sharing my slide. So as mentioned, present value refers to put passive values on an even playing field. We compare monies using a concept called present value. Now, present value refers to the interest adjusted value of future payment streams. So as mentioned earlier, I think I already mentioned it quite well, but again, present value refers to the interest adjusted value of future payment streams. So considering, let's say, for example, if, let's say, I think this is more relevant towards finance in terms of cooperatives or banks, wherein people have to pay loans now, and those loans have interests. So let's say, for example, you are the owner of, not really the owner, but let's say that your family owns a lending business. And in your lending business, you lend, I'll just use the same values that I mentioned earlier, 5,000 pesos. So in your family, you lend, um, you have a client, and then you're going to lend 5,000 pesos to that client. So, and then that would be a loan, all right, and then that loan would then gain or profit interest throughout the span of time that that loan will run. So for example, you lend 5,000 pesos to your client at an interest rate of 8%. So that's quite high, actually, if you think about it. So that means that if we I'll just share my calculator as well. So using a calculator, let's just share a calculator for this. All right. Now, using a calculator to compute the interest rate, so we have here 5,000 pesos times 0.08 because the interest rate is 8%. That means that that's our interest rate, no? 400 pesos for each month. So that means that with the money that you are lending your client, you earn 400 pesos per month because that's the interest rate. And so, what would you prefer then? If we were going to go back to the example earlier, what would we prefer? Would we prefer to earn just, let's say, the time value of money, right? So interest, or rather present value, refers to the time value of money, or rather, um, as mentioned earlier, sharing the tab, the interest adjusted value of future payment streams. So throughout time, let's say the loan will run for about a year. So your client has a year to pay off the loan. So let's divide 5,000 by 12 because 12, there are 12 months in a year. So that is 416 pesos. So that means that the client would have to pay 416 pesos plus interest per month. So I think the interest rate is actually very big if we put 8% for just 5,000 pesos. But usually um, for some lending organizations such as FICO, they just put 5% interest rate or 10%. No, yeah, 5% interest rate would be a big interest rate now. So that's 250 per month if it's if the interest rate is 5% for 5,000 pesos. So in short, if you were a lender, obviously you would prefer to have the interest rate, or rather, have the client pay for their loan for a longer period of time, because the longer that they um, have the loan, the more interest you will get. So that's rather the idea of present value. So that means the interest adjusted value of future payment streams. Now, at this point, class, we are going to watch a video of present value from. I'll just show two videos this morning. The first would be from Jacob Clifford, uh, Mr. Jacob Clifford, the host of Crash Course Economics. And then the second one will be from Professor Jody. So Professor Jody teaches economics in the MBA program of. So that's Professor Jody Beggs. She teaches econ in the MBA program of a university. So let's proceed. All right.
I have a question. Would you rather have $100 now or $200 sometime in the future? To answer that question intelligently, you're going to need more information. First, you need to know how long before I pay you the $200. And second, you need the interest rate. Time is money, and the value of money depends on time. Let's start off simple and look at the decision between taking $100 today or $100 a year from now. And let's assume that the interest rate is 10%. So what is the value of $100 today in 1 year? Well, you could take the $100, put it into a bank, and get that 10% return. And so the future value of $100 today is $110. The future value of some quantity of money is the quantity of that money today times 1 plus the interest rate. To figure it out for 2 years, it would look like this. The quantity of that money times 1 plus the interest rate squared. And for 3 years, it would be cubed. Clearly, you'd rather have $100 today than $100 a year from now. Instead of looking at the future value of $100 today, let's look at the present value of $100 a year from now. Well, to get it, you need this equation. The present value of some amount is how much it is in the future divided by 1 plus the interest rate. For 2 years, it would be that amount divided by 1 plus the interest rate squared. And for 3 years, it would be cubed. So let's find out the present value of that. The $100 divided by 1 plus the interest rate of 0.1%. And that comes out to be $90.91. That's the present value of $100 in 1 year from now, given the fact there's 10% interest. So again, it's clear you should definitely take the $100 today as opposed to $100 in the future. Now let's go back to the original question I talked about. Would you rather have $100 now or $200 in the future? Let's assume the interest rate is still 10%. I'll give you $200 2 years from now. So use the equations I showed you earlier to calculate the present value of $200 in 2 years. Find out if it's a good deal for you. The present value of $200 2 years from now is the $200 divided by 1 plus the interest rate of 0.1 squared. And that comes out to a little over $165. So in that situation, you should definitely take the $200 in the future, because the present value is more than the $100 I would give you today. So the reason you're learning the time value of money is to understand that money and time are related. And it's also going to help you understand the idea of compound interest. For example, if you knew you needed $200 2 years from now, you'd know to put $165 in change in the bank, and that would eventually become $200 in 2 years. I hope this video helped you understand the time value of money. Make sure to take a look at the next video that's going to explain T accounts and the whole idea of money creation by banks. Also,
Okay, let's just rewind to the point about the formulas, because I think that was very fast.
$100, put it into a bank and get that 10% return. And so the future value of $100 today is $110. The future value of some quantity of money is the quantity of that money today times 1 plus the interest rate. To figure it out for 2 years, it would look like this. The quantity of that money times 1 plus the interest rate squared. And for 3 years, it would be cubed. Clearly, you'd rather have $100 today than $100 a year from now.
So we also saw the importance of compound interest. That is, in 2 years, if we put that amount of money, not $165, or that's roughly, we were to convert that to peso, 8,250 pesos. So if we put 8,250 pesos in the bank or in an investment plan that earns 10% interest per month, or per year rather, so that would grow to $200, or roughly in peso, that is 10,000 pesos. So in 2 years, your 8,250 would grow to 10,000 pesos. And that's called compound interest. Now let's look through the idea of further explanations on present value. Let's watch another video, the one that I mentioned earlier, the video from Professor Jody Beggs.
The concept of present value, or alternatively present discounted value, comes up all the time in most finance classes and a lot of economics classes. But students are usually just given the formula and not given a lot of insight into where the formula came from. So what I want to do here is look under the hood and understand where the present value formula actually comes from. Let's start with a problem that people are generally comfortable with, that being taking some money and moving forward in time and having that money earn a return. So let's say we're investing $100 at an interest rate of 5%. We're investing that money for 3 years, and our interest is being compounded annually. Note that our interest rate of 5% is 5% per year, and that when we use this to calculate our final amount, we're going to use the number 0.05 rather than 5. So we can calculate the future amount by just applying the interest rate. And we'll notice that after 1 year, we'll have our original $100 times 1 plus the interest rate of 0.05, because after 1 year, we'll have our original $100, but then we'll also have the interest on that $100. After 2 years, we'll have the amount that we had after 1 year, again, earning interest. So we'll have that amount times 1 plus, again, the interest rate of 0.05. And of course, after 3 years, we'd have the amount that we have after 2 years. Again, now that amount earning interest, therefore we'd have to multiply the 2-year amount by 1 plus the interest rate of 0.05 one last time. Another way to write this would be just to say that the future amount is equal to the original amount of 100 times 1 plus 0.05 to the third power. Numerically, this is equal to $115 and about 76 cents. More generally, we can say that our future value, or the amount we'll have in the future, is equal to our present value, or the amount we're investing today, times 1 plus our interest rate as a number to the nth power. You can think of this n as the number of compounding periods. In this case, because we were compounding annually, our compounding period would be a year. So of course, in this case, our n was just 3. In general, you want to make sure that your frequency of compounding, in this case annually, lines up with the way you're measuring your compounding periods. And also that this lines up with the way that you're looking at your interest rate. So for example, if your compounding period is a year, your interest rate needs to be per year, and so on and so forth if your compounding period was a quarter, a month, etc. Also note that the original $100 that we invested today counts as our present value in this formula. So far, so good? Now let's look at a closely related problem. Let's say now that you know that you want to have $100 after 3 years.
Take note, class, that the answer is $115.76, or that would equate to, this is the future value of $100 in 3 years now at 5% interest rate. So if we were to convert that to peso times 50 pesos, that's 578. Is that correct? 115.76 times, is that divided times 5,788. So that is 5,788 pesos. So in the future, at 3% interest or 5% interest rate, 5,000 pesos would be equal to, the future value would be 5,788 pesos. Not bad. So the future value is actually the present value, that is 5,000 times 1 plus squared by the, or to raise to the power of the year. So let's go to the next slide here.
Let's look at a closely related problem. Let's say now that you know that you want to have $100 after 3 years, and you want to understand how much you have to invest today in order to make that happen. Again, let's say our interest rate is 5% and that our interest is compounded annually. Logically, we know that we should have to invest less than $100 today in order to get $100 in the future. And we can actually use the same formula that we had been using to go forward in time to go backward in time. In this case, our $100 after 3 years is in fact our future value, because that's the amount that we want to have in the future. Our interest rate is our I, of course. Remember that we want to put our interest rate in as 0.05 rather than 5. And because we're compounding annually and looking at a 3-year time horizon, we know that our n is 3. If we plug this all into our formula, we see that we get 100 is equal to our present value times 1 plus 0.05 to the third power. And now we can solve for our present value by dividing both sides by 1.05 to the third power. So we could say that our present value is equal to 100 divided by 1.05 to the third power, which is $86 and about 38 cents. Note that all we've done here is rearrange the formula that we had initially used to go forward in time and collect interest on our money. And we can say that present value is equal to future value divided by 1 plus the interest rate to the nth power. If this looks familiar to you, it's because it was in fact the formula to you as the present value formula, but now you get a little bit more insight into where it comes from. In our example, we describe present value as the amount we would have to invest in order to get a certain amount in the future.
All right, class. So that is actually the difference between present value and future value. So as mentioned, the present value is the money, no? Refers to the money amount today. So the value of the money today. Now, just to reiterate, present value is the value of the money today. So as earlier, as mentioned, the value of 5,000 pesos today, using the formula that was the value of the money divided by 1 plus the interest rate raised to the power of time. And so 5,000 pesos at 10% interest rate was earlier in the example was equal to 4,545 pesos. So that would be the present value. If we were to put 4,545 pesos into, I'll just use the PowerPoint as the visual aid. So just to reiterate that point, class. Okay. So to reiterate that point, when we were using the formula earlier, so the formula that we were using for present value, I'll share my screen for a moment, was found in the book actually. So as mentioned, the formula for the present value is the payment for the amount of payment, that is 5,000 pesos, divided by 1 plus the interest rate. Interest rate is R, raised to the power of the number of years before payment is received, or the number of payment or the number of years that you would like to receive the payment. And so I'm using that formula. Plus we get the number. Let's just go to the PowerPoint. We get 4,545. This is the answer, no? And with 4,545, this is the money that would be, for example, if we were to invest 5,545.45 pesos in the bank at 10% interest rate, that would earn 5,000 pesos in a year. So that's that is present value. That means the value of the money today. And however, within a year, then that money would earn 5,000 pesos. So that the present value is basically the interest adjusted value of future payment streams. So let's say, for instance, if we want to earn X amount of money in 2 years' time, then we would compute for the present value. The present value would usually be lower than the future value because interest rates earn money throughout time. And so the future value, on the other hand, as what we had learned, is the value of the money in the future. So using the formula that was shared earlier, that is for the future value, the formula is 1 plus, or the number, the payment, the money payment, 1 plus r multiplied by 1 plus r to the power of n. That's, we'll just use to the power of n. That's usually the formula for power of n. So that's how we get the future value. So 5,000 in our example, 5,000 pesos times 1 plus 0.1, because we have 10% interest rate raised to the power of 1. So the answer would be, that is future value of, if we were to compute that, we found out that the future value of 5,000 pesos is, we'll give that again, 1.1 times 5,000 is 5,500. So the future value is 5,500. We'll just put that into bullets. The answer for this would be 5,500 pesos. If we put in 5,000 pesos today, so in the bank, so in a year's time, that 5,000 pesos will become 5,500. But if we want to know if we, how, when, for example, if we want to earn 5,000 pesos in a year in the bank, we invest 4,545, the present value. I hope that's clear, no? Now, I'm going to the, I'll just stop sharing my screen in this manner. All right, so going to the book, let's just discuss about interest rates per se before we proceed to present value. Here. All right. So let me just adjust my taskbar settings. Okay, and go to read mode. Now, in the book, no, we have interest rates. So the market for money, as mentioned in the book, when people lend or borrow money, we call the price at which they do this as the interest rate. And a useful way to think of this market for money is to imagine yourself renting a moving van. So when you rent such a vehicle, the owner is letting you use it for a predetermined period of time at a predetermined price. Now, instead of renting a van, think about renting money. The owner of the money is letting you use the money for a period of time at a predetermined price. So that's the idea of interest rate. Of course, you could be on the other side and be the owner of the money that you put in a bank or use to buy a bond. So you're now renting the money to someone else. In all cases, the rate of interest is an important component in your transaction. In this market that we're discussing, the seller is the one with money and the buyer is the one seeking the money. Just to double check if my... So here, the equilibrium interest rate will depend on a number of factors. For instance, the interest rate for people with good credit histories is typically lower than it is for people with poor ones. So sometimes banks would give higher interest rates for people who do not pay their loans on time. No, but there are lower interest rates for people who do pay their loans on time. And so I guess we could just refer to that for interest rate. Present value, just to discuss about what was discussed in the book on present value. I think that was quite clear already for us. So to use a particular example, consider what $200 paid. I think that was already quite clear now. Let's go to mortgages, car payments, and other multi-payment examples. So we can use this concept of to calculate how much house or car we can afford. Here, instead of borrowing a single sum and paying it off with a single payment, we are borrowing a single sum and paying it off in small increments. So, of course, we could think of situations where we save in a small increments to generate a single sum, like saving for a vacation, or situations where we save in small increments to generate other increments, like saving for retirement and getting a monthly check in retirement. These are simply extensions of the same principle. So for each of these examples, there's a wonderfully elegant formula that would allow us to plug in various numbers and get results. These formulas are not necessary for us to understand how we might use the present value idea in these other contexts. So for that, suppose that an investment of $5,000 or 5,000 pesos each year for 5 years will starting in the sixth year return a payout of $100 a year. So that's an equal number in the sixth year. No, this is an investment. So let's say if we put in 5,000 pesos today, and then in 6 years' time, that money would give us a return of another 5,000 pesos a year. No, by the sixth year, that will continue for the next 7 years. So that would be by the 13th year, that would be the amount of money that would go back to you. Suppose the appropriate interest rate is 10%. In the figure, the down arrows indicate payments being made and up arrows indicate payments being received. So this is the increments. Now, usually for investments such as life insurance policies, the increments will be indicated in the plan that will be sold to the client by the financial advisor. So these are the increments basically. So this is for the first year, the second year. So I believe the formula that is used here is still the present value. So in $100, that is in our time, this should be in our currency. This should be 5,000 pesos. So compounded, this would be the amount that would be earned, no? The amount here. This would be the amount that would be earned in 1 year's time, 2 years' time, 3 years' time. So that's 90. And then by the sixth year, as you can see here, the money would return as $62, which is roughly in our currency, $62 is equal to 3,000 pesos. So by the sixth year, the money of 5,000 pesos will become 6,000. 3,104.5. So it actually decreases, no? If you look at it from 5,000, it becomes 3,000. So monthly payments required on a $1,000 loan. So $1,000 is actually equal to 50,000 pesos. So the monthly payments on a 50,000 peso loan for various interest rates would be that for 5% interest rate, 2%, 1%, 10%, or 20% interest rate. For the first year, this would be the payment. For if this was to be paid in how many years? 1 year. If 1,000 pesos was to be paid in 1 year, at 1% interest rate, this should be the payment per month, $83. So it's just about dividing let's say you're loaning money and that's 50,000 pesos. If you divide that by 1 year, no, you would have to, that's 12 months, you would have to pay 4,166 pesos. Does that equate to, but interest rate was not included there yet? Yeah, basically that's $83, 4,189 pesos at 1% interest rate. So these values equate to the monthly payments at these indicated interest rates. So investing is a risky business. This lesson actually talks more about investment and how much your money would grow throughout time. So investing is risky business. Some investments do not pay off as expected. Economists look at risk, at the possibility that the investor will not get those anticipated payoffs. There are two basic types of risks: the default risk, where the borrower doesn't pay the debts, and market risk, where the market value of a stock or bond changes in an anticipated manner. So to compensate the investor, a greater reward is offered. Economists call that greater reward the risk premium. Because longer term productions are often less accurate than shorter term ones, there is also a relationship between the reward an investor receives and the length of time the investor must wait to get that reward. Economists call that relationship between reward and the time you have to wait to get it the yield curve. So relating to risks, rewards, and the yield curve. So here, the yield curve for US Treasuries in January 2005 with maturities to 2035. So the yield year, if an investor puts money in back in 2005, they would get their yield around 2014 up to 2032. So that's the time when their money would come back to them. So it's really about a time element. So if you're thinking of growing your money, it would be good to look for a good vehicle where your investment can go. It's either in the stock market, if you want to learn more about that. There are some groups that actually teach people about financial literacy. So it's either you put it in the stock market or in Bitcoin, although Bitcoin is different. And maybe we could discuss about that in other lessons. No? And then, or you could put it in the bank, but the bank's interest rate is actually very low or very small. It's best to actually put savings not in a co-op like FICO, because the there are more rewards actually, or returns, because in FICO, if you put your savings in the cooperative, you would get to loan for you would be able to loan after you put in savings for 3 months. You would have the capacity to loan. So again, our lesson, no, our objective for our lesson, this is actually lesson 2. The objective of our lesson on interest rates and present values for you to understand what interest rates are, and then for you to recognize why present value is a tool to use when thinking about economic decisions where the costs and benefits happen at different times. So I hope that you were able to learn the time element of money, that if we put in money during this certain time in the present, then we would know that in the future it would yield X amount of money, considering the interest rate of that money. On the other hand, future value refers to the amount of that money in the future, whereas present value refers to the value of that money today. But if you were to anticipate to earn, let's say, as mentioned in the example earlier, if you were to anticipate that you want to earn 5,000 pesos a year from now, how much money should you invest in the, let's say, in the co-op or in the bank, or in your investment, in order for that to grow to 5,000 pesos a year from now? So that the present value refers to the amount that you should invest in or save or put in the bank. That was 4,545. So a year from now, that is the present value, 4,545. A year from now, your 4,545 pesos will become 5,000 pesos if you were to put it in a vehicle that would earn 10% interest rate per year. So that's the present value. The present value, again, is the value of the money today, whereas the future value is the value of the money in the future, considering interest rates. So I hope that was clear enough. For our assessment on Wednesday or Thursday, we will have an exercise, actually, or rather during our class, we will have an exercise on computing present value and future value. And then we will also, that would be our activity for the synchronous class now. On Wednesday and Thursday, we will have exercises, and then we will proceed to the assessment for lessons 1 and 2. That was macroeconomics and interest rates and present value. The, the assessment will be identification and then essay. So the essay will revolve around you discussing about the business cycle, for example, just for us to know if you understood the concepts of economics. So that would be the essay, and then for the latter part of the assessment, you would be given a problem no, on computing the present value of an investment, or rather a situation wherein a person, no, just a problem solving exercise wherein there will be either a problem on investment, and you would have to compute for the present value and future value of a certain investment, and all of the values will be in peso currency for our exercise. So for questions, we can have Q&A during our synchronous class. Thank you, class, and I'll see you in our Google Meet calls for the week. Have a good day. Bye-bye.